Hi. As we discussed in my previous video, under Secure 2.0 for certain higher wage employees, catch-up contributions must be made as Roth contributions rather than pre-tax. Specifically, if an employee exceeded a threshold of FICA wages as reported in Box 3 of the W-2 in the previous calendar year, and came from the employer sponsoring the plan, then in the current year, any catch-up contributions must be designated as Roth catch-up contributions. And this is codified under IRS Code Section 414 V7 of the tax code. But what happens if a participant who's subject to the Roth catch-up requirement mistakenly makes a pre-tax catch-up contribution instead of a Roth contribution? Now that's an operational failure and it needs to be fixed. Thankfully, the IRS considered that possibility and they laid out the rules employers can use to correct that failure. Under the regulations, there are actually three methods administrators may use to correct a failure of the Roth catch-up contributions when a pre-tax catch-up was made but should have funded it in Roth dollars. However, the plan may need to meet certain prerequisites to use them, and there are deadlines sometimes for implementing these fixes. Under the first correction method, the catch-up contributions plus any gains or losses are moved from the pre-tax contribution source into the Roth contribution source inside the retirement plan. The employee's W-2 for the year in which the catch-up contribution was made is actually adjusted to report the contribution amount without gains or losses as a designated Roth catch-up contribution. And the contribution is included in gross income in the year it was deferred as a Roth contribution. So basically, you're going to correct the issue by reporting what should have happened as if it had actually happened. Now, there are two prerequisites to this correction method. First, it can only be used if the Form W-2 for the year hasn't been filed with the IRS or furnished to the participant. In addition, the plan has to have practices and procedures in place that are designed to ensure compliance with the Roth catch-up requirement at the time deferrals are made. And this includes a deemed Roth catch-up election. For the second correction method, the pre-tax catch-up plus gains or losses is actually converted or rolled over inside the plan from the pre-tax account into the Roth account. Now, this moves the amounts that should have been Roth into the Roth bucket. And then the rollover or conversion is reported on Form 1099-R for the year in which the rollover actually occurs. The amount, including gains and losses, is included in gross income for the year of the rollover. Now, this same method also requires that plan satisfy practices and procedures requirement that we talked about in the first correction method. However, this can generally be used after the W-2 has been filed. Now, finally, and this one is little talked about, plan sponsors can also use the existing return of excess distribution correction method that's already available under the Employee Plans Compliance Resolution System, or EPCRS. The plan can distribute the excess pre-tax elective deferrals adjusted for earnings that were required to be designated as a Roth catch-up contribution and designate them as an excess plan contribution. The contributions plus any earnings would be distributed to the employee and reported on a 1099-R. Now, this correction method doesn't require any prerequisite because you're essentially designating these dollars as an ineligible contribution to the plan. The regulations also provide various deadlines for making these corrections, depending on the scenario. So please feel free to reach out to me at rmassa@primefinancial.com if you have any specific questions. But the primary thing to keep in mind is this: contribution mistakes, such as allowing a catch-up when a Roth catch-up was required, must be corrected properly, or you may face fines, penalties, or even risk losing the tax qualified status of your plan. Now, I understand there has been a lot of consternation about implementation of Roth catch-up contributions from employers all across the country. And yes, your concerns are valid. I do believe, though, the correction tools the IRS has provided are helpful in alleviating the average employer's concerns because there is now a way for employers to fix these problems. And I also want to remind everyone that 2026, for all intents and purposes, is a transition year for these rules. And while these rules are in force as per the final regulations, employers only need to show good faith compliance in 2026. So just do your best to comply with the rules and use these tools as a fallback position. And if I can share one final piece of advice, it comes from one of my favorite books from my childhood, The Hitchhiker's Guide to the Galaxy. And if you know the book, you know the phrase, don't panic. I hope this has been helpful. I'm Rob Massa, the Foracle from Prime Capital Retirement Use in Texas, and I am wishing all of you a successful retirement.